Fred had the role today of giving a very positive overview of the industry and its developments. And here comes the outsider who says AI hasn't done well in the recent couple of months. Let me just grab the presenter here. I'm today in the position of somebody who watches the scene with interest, without very specific knowledge of who is doing what. And I see we had a financial market crisis recently, triggered by the pandemic, the corona pandemic. And I say this was the most data-driven or data-powered crisis that we had in the financial world. AI should have performed extremely well in this type of situation. I have to say, I am disappointed. We had AI, we had big data all over in the recent 3 months. Corona was covered extremely well, and I will show you a few examples in a few minutes. And AI was used widely during the pandemic to diagnose diseases, to see new kinds of treatment. We had extreme worldwide collaboration with scientists and in data sharing. And by combing through scientific papers, new treatments were being sought. But in the investment field, AI was not really helpful. None of the models even remotely caught the sudden downturn in stock prices. Apparently, the data that we have, the models that were being used, and the forecast that these models tried were not aligned well. My first statement was that COVID-19 was the first epidemic with live statistical coverage around the world. From the very first cases in Wuhan, the data were available widely throughout the world. And this is just one example from the website, Our World in Data, where you could watch daily for each country. You could see all the statistics. Now, this is just one very specific statistic. You can see day by day the testing in different countries, across different countries. You can select them. You can normalize them by population. You can divide them into each other. So it was extremely well, statistically well modeled. And that's what I did in the beginning. I made my own little polynomial model based on the data from Wuhan. And it showed me that the crisis was apparently worse than people thought here in the West. So the data were there. You could even get live data or almost live data from websites like this one. This is from the maker of an electronic thermometer. When people measure their fever or their flu, they can upload the data through Bluetooth, and you get a map of the United States telling you where you find elevated levels of body temperature and atypical for this time of year, where you normally have a flu season and you have elevated body temperatures anyhow. And this is, for example, one map that is published, I think, daily, showing you where exactly are the hotspots in the United States. You can see that New York and New Jersey were heavily under the spell of the virus. You can see Florida, you can see the disease spreading to the southwest of the United States. You see a hotspot in Chicago. All these data are widely available and easy to share. You can even model mortality with this system. These are the body temperature levels, and with a certain time delay, you can see the deaths that result out of these body temperatures. The data were there available. And we talk about a world of big data, and finance is proud to use big data. These data apparently were not widely used. On the other hand, in the scientific field of medical research, we found that data sharing is very widespread. There are, I think, about 5,000 new papers out every couple of days on coronavirus, on COVID-19. And it's almost impossible for a human being to screen them. AI was used to screen the scientific papers and to see what's new in the field, what can help the treatment of the virus. AI was also used to use historical scientific papers to see, are there any correlations between previous treatments or previous medication and the coronavirus. And there's one drug which is quoted here, which was actually discovered by using AI in screening through scientific pharmaceutical papers. I don't know if this drug is successful, at least it's being tested, but it shows AI can be used in these types of crises in worldwide collaboration. Now, what I would expect now from investment management or AI in investment management, that funds show a certain performance when they claim to use AI. There are funds that, I mean, it also depends on the type of fund. There are funds with a short-term focus, funds with a long-term focus. If you have a short-term focus and a multi-asset approach, and if you use big data and use AI, then I would expect that the downturn that we see or that we have seen should have been anticipated, either from financial statistics, watching what is happening in the financial world, and we have lots of data there, real-time data. Just to give a few examples, we have spreads between different types of financial instruments. We have volatility measures, we have dispersion measures, we have vol, we have correlation measures. All these indicators are out there in real time, observable, and they showed a few days ahead of time that a tension was brewing in the financial markets. Or you could use alternative data, traffic, shopping, fever. And I read today that beginning in August 2019, you could watch that hospitals in Wuhan had an elevated activity. You could probably see from space what traffic is like in the Wuhan region, what shopping activity is like. So all these data, in my opinion, should have been available and could have been purchased by the builders of AI models. If you didn't catch the downturn ahead of time, at least you should have caught it halfway through. There was a one-day big sell-off mid-March, and during this time it should have been apparent that there was something wrong with the financial markets, and at least I should have expected a stop loss or something of that kind. I didn't see it. Or if you claim to be market neutral, then you shouldn't have been bothered by the financial crisis that we recently had at all. Now, with funds with a longer term focus and the use of AI, I would expect resilient stocks in the portfolio, stocks that are crisis proof and that make it through good and bad times just as well. What I did observe, I did not see any single smart model that predicted the downturn, at least that is from my outside perspective on the market. Alternative data, I did not watch that these models or the data-driven models caught the downturn. Instead, naive models were much better. I did not see a halfway stop loss. I saw a few cases of market neutrality, and the question is still out if we saw resilient stocks in the portfolio. I think we can only see this maybe half a year down the road when the first recovery is through. There's maybe a second backlash, and then we see who was really resilient in the markets. At this point in time, I couldn't really watch it. Now, I take quotes from previous conferences that we held in this AI theme of AI conferences. And I'm quoting from previous presentations. Let me read. 2 million relevant tweets, news articles, research, blog utilized daily. 17 messages per second from 38 million authors. That was in one of the previous presentations. Another one said, the system captures hundreds of millions of tweets daily. NLP, that is natural language processing, algos extract the mood across securities, government and politics, which can be compressed into powerful sentimental signals. None of these models actually did what it claimed to be able to do. AI was unable to draw the right conclusions from the multitude of information. And now let's go to probably the best informed person in this world, a stable genius, at the top of a country, on top of the best pile of information, and even he did not see it coming. In January, this person said, we have it totally under control. In February, it's a miracle, it will go away. He said, this is a new hoax, it is not real. In March, this best informed person in the world said, we are in great shape compared to other places. I didn't take responsibility at all, and he has always known that it is a pandemic. So from hindsight, it's easy to be a good forecaster. In real time, he didn't see it coming. Instead, you have somebody, that is myself, reading a newspaper, a paper newspaper, very old-fashioned. And I go through these old newspaper articles from January. We have the German Federal Ministry of Health. They said the danger is very low. But people are worried in Wuhan. That is the second article that I'm quoting here. And then, for me, probably the most relevant news source is The Economist. And they have a picture of the planet with a mouth protection. Will this become a global pandemic? And if something is on the cover of The Economist, I say this is something relevant. Now, my own conclusion from these very few data pieces, from my physical newspaper, from reading The Economist, and a couple of other news sources, this doesn't look good. And I put in a put protection for one of our portfolios on January 27. A human being who finds what is relevant and what is not relevant. I don't have access to millions of data sources. I know what is important, who are good observers of what is going on. And this information was sufficient to draw a good conclusion, to put in a put protection. So I'm disappointed what the models delivered. If a human being with a moderate understanding of news flows, information, and relevance can draw the right conclusions, then I wonder, what did the AI models actually do? There's one model actually that captured the situation well, and this is a very classical model from Goldman Sachs, a risk appetite index. It is made up of about 50 different data sources from the financial world, things like I said earlier, spreads, volatility, interest rate spreads, risk indicators, etc. I believe it's not AI. I don't know the intricacies of this model, but it said clearly we have lots of financial stress at the moment, and it happened at the almost right time. It went down one day before the March 12th, before the big sell-off happened. So I'd say conventional model with the right pieces of information delivered better than the AI-driven models that I have seen so far. And then we have a model that is not a good predictor, but that captures the situation in the world quite well. This is the model, the Buzz Index of Periscope Capital, a Canadian firm. And they look at tweets and news and try to draw sentiment out of those. And it's not a good predictor, but it watched the news flows that are happening. And the data that it gave, which came out on a monthly basis, the positioning of, for example, Walt Disney went down from 3.0% in January to 1.37% in March. Now, Walt Disney is heavily hit by the current pandemic because people don't watch it at the theme parks anymore. And if without sports, they don't have any revenue from ESPN. Delta Airlines from 5.7, a very high weighting in February, down to 2.26%. So the heavy weight in this airline from 0.57%. So quite contrarian, they said Delta Airlines probably hit by the crisis, but will probably recover well. Occidental Petroleum, heavily hit by the oil glut, from 0.65% in December up to almost 3% in April. Quite contrarian view, which seemed to be exactly on spot. Gilead, the maker of the remdesivir drug, which is used to shorten the time of the disease. It doesn't decrease the mortality, but it shortens the whole time, from 0.59% to 3.0%. And Zoom, the video combinations company, from 0.59% to 2.56% in April. So Although it's not a good predictor, it captures the mood and the sentiment and the risks of certain companies quite well. Let's take a look at our own funds. We have to be self-critical. There are 3 funds powered with different types of AI. And there's one fund that is the one powered by the sentiment index, which is the red line, which you see on top, and it's now on the positive territory for this year, much better than the MSCI World Index in white, and much better than our fundamental data-driven funds, which are below the MSCI World line. Not comparable, nothing is comparable here in this sample, because everybody has his own objectives and rules, but a pretty good indicator that you can at least capture the mood if you use these social media data. Another source from Plexus Investment, which is a Swiss-based company, Swiss-based asset manager. This is an Outperformance Index of various funds that are powered by AI. And it shows that 1/3 of these funds outperformed during the recent months and 2/3 roughly underperformed. The same observation that we had on our chart of our own funds. I took a very unromantic, unsentimental look at all the funds that I know of. They come from Fred Sage's database, they come from our own database, and I put them on 4 charts here, always 9 funds or 9 indices on one page. And if you look in the middle, this is, I think, the MSCI World Index. And you see the funds, which you can see by the blue shade. Blue shade is a fund without just a straight white line is an index. And you can see all these funds, these are our own funds, basically track what the MSCI World is doing. Then, next page, I have 4 pages of these. There's one fund that seems to be doing something different. It's in the middle, at the bottom of the page. I will get to it in a second. 2 more funds on this page, which apparently are not correlated very much with the market. The rest of the page is basically the market, the world market plus or minus. On this page, one very peculiar fund on the top right, which I find quite interesting, and the rest again, pretty much tracking the MSCI World. What are these 5 funds that I've highlighted? Number 1, the first one, which I mentioned, is based on artificial intelligence using stock tweets. The second one is an index-based fund. It tries to get market conditions by utilizing AI, but not purely AI. So this is the SNUG index. It also has a very short history, so not quite representative. Then we have the ART AI Equity Fund, which did reasonably well, using alternative data. Then with the Genio Primo Systematic Macro Program, a global systematic macro program that also uses AI, but not solely. And the Tungsten Tricon AI Global Market Funds, which uses AI since 2013. So these are funds that we should study more and see what they did different from the rest, which basically followed the index. I've taken the lifetime pictures of these funds. On the top right, for example, you see the SNUG fund, which started only in February, and the other funds here over longer time horizons. And you see, for example, in the lower left, that although the fund did well in the current crisis, it did not do spectacularly well over its lifetime. So you have to really take a lifetime view and also the current crisis view to get an overall picture how the strategies are working. And I hope to learn more today during the course of these presentations, what these funds did and why they did it. Now, to get to conclusions, I see that we are accelerating in artificial intelligence worldwide. Now, it used to be a hype maybe 2 years ago, and right now it's, I would say, going from the 95% to 97%, which is a big step. Remember seeing AI identifying cats and identifying dogs and traffic signs, etc. So that was the first wave where you thought this is phenomenally interesting. It can be used to power everything in the world, and that was the theme at the time. We are slowly moving forward, step by little step. For example, in voice recognition. An author recently wrote that get voice recognition at 95%, it's not really useful. If every 20th words has to be corrected manually, you don't save much time. If you're at 97%, it becomes useful. If you get to 98, 99, then it's really a very practical tool. But these extra 2% cost a lot of research and training and computing power. Same with transcription. I use stock transcripts quite a lot, and I sometimes find very funny transcriptions, apparently because the system just doesn't know our terminology, doesn't know the names of people that are being quoted in these papers. But we are progressing, and this stuff is pretty fast. In a few hours after a meeting or presentation, you have it transcribed already. And in translation, I'm a big fan of the Cologne-based translation service DeepL, and it works beautifully across a couple of language pairs, for example, German and English, and it works in a very mediocre way across other language pairs, for example, Italian. So it says we are progressing. It becomes really useful over time, but it's a long and very steep ascent that we have to go. Musical composing. A couple of years ago, Sony Labs had a couple of artificially composed pieces out there, and I think we have more and more musical composing driven by AI, and we don't even know about it. Image recognition and rendering. I expected the first self-driving cars to be on the road already. It takes longer, but I think it will come with a vengeance. I believe that image recognition in driving will probably save thousands of lives worldwide, and I'm really anticipating this to come. I see lots of new papers and models which are not fundamentally new, but more elaborate and voluminous. Now, the most recent example is the GPT-3 model published by OpenAI, a language processing model, version number 3, now with 175 billion parameters. Basically, it's the whole world of written data that's being processed in this model. And it's amazing what it can do and who it can fool. It's still not intelligent, but it's amazing how it can draw conclusions. And I think if you have it in a test, many people wouldn't recognize that you have a computer on your opposite side, behind the screen, who's answering your questions. Amazing. But still not perfect. But in finance, I don't see much visible progress. I see conventional models, as I mentioned before, the Goldman Sachs model, doing quite well. I see human intellect doing quite well. And I don't see yet the big breakthrough. The current situation in AI-powered funds, and Fred Sage mentioned it earlier, we have currently the following strategies that are observable. Equities long only, equities long short, equities market neutral. There are a few select fixed income funds in very narrowly focused fields. Managed futures, multi-strategy. I think this is a range of AI-powered funds that we can currently observe. Most of them that we watch are in Europe and the United States. I'm glad that the Europeans are quite strong in the field, but we don't see what's going on worldwide. I think many models are kept under wraps. And then, as Fred mentioned earlier, roughly 1/3 of AI funds were liquidated last year, closed or sold. Only established managers with a longer-term track record and meaningful assets under management, saying 3 digits or more, were able to increase their volumes. Now, I would like to conclude and use my last 3 minutes before we get to Q&A to say what works and what should be done. What I noticed and what other observers in this industry, for example, Plexus Investment, notice is a narrow focus helps. So if you are in municipal funds and only do this field and only look for the peculiarities of this field, then you are able to get an outperformance using AI. Apparently, long only works better than market neutral. Apparently, a smart use of alternative data is very useful if you know how to use them. What apparently did not work, market neutral. And what we saw during the crisis, an increased divergence between the well and the poorly performing funds. In good times, when the stock market is going up all the time, it's easy to swim along with the crowd. In bad times, the spread goes wider, and that's what we observed very recently. I would like to give recommendations to the industry and to my colleagues in the field. It's a very personal opinion. I don't know if many people share it, but I'd say define a narrow problem and solve it. The reason being, the big models where you put in everything and try to predict everything and put something, a black box in the middle, apparently doesn't capture what's relevant. Lots of garbage in, very few data observation points on the way out. A big model, and you always get something which doesn't hold up in real times of stress. And the reason why I'm using, or was using the newspaper articles earlier, learn from examples like a child. Now, a child doesn't need to touch 100,000 hot plates to find out that you can burn your fingers if you touch the stove. A child does it once and has learned the lesson for a lifetime. Might be the wrong lesson or the right lesson, but it learns very quickly. A baby doesn't need to study a whole encyclopedia to know who is mom and who is dad. It learns these words quite easily from very few examples which are relevant. And for myself, if I have a cover story on The Economist, I think it's relevant. The Economist is a very meaningful observer. A cover story there means something, which helps me to identify significant news sources and less significant news sources. Find good input. If you throw in everything from supermarket attendance to mobile traffic, you find patterns all over, the weather, everything included. But try to find information sources that correlate with your problem and are fundamental to your problem. And if you've done all this, defined a narrow problem with a defined time frame, short-term, long-term, whatever, the right input sources, the right definition of the problem, then I think the model in the middle is not really the most important component. It can probably get the extra mile out of the data, but I think the problem definition, data cleanup, the relevant data and the right problem definition are much more relevant than the model. And would encourage everybody who is presenting today to maybe respond to my ideas, and I would encourage every newcomer who is in this industry to concentrate on these questions and not to try to put everything into a big box. Let somebody process it and hope that something comes out of it. I believe this does not work. Thank you.
Hendrik, thank you very much for your interesting views. And I wish there were some people coming from the science side who are sitting alongside me, but that will happen in the future because I'm sure that they will have some very interesting questions and comments. I have a couple of comments that might sort of lead into questions, so please sort of jump in. You mentioned something about alternative data that would be extremely helpful in using to predict things like that have recently happened. In my experience in talking to managers around the world, many of them, once again, are, let's say, innovators, don't have much money, which is typical in any innovation, and they just can't afford the expense of this alternative data. Maybe the large firms who are sort of playing around with artificial intelligence and so forth are able to do that. I mean, I'd like to hear more from the alternative data providers in terms of how much they're actually selling. But this is one of the challenges, and I'm not sure people should sort of expect that these managers are using this data for the reason that I mentioned. Also, this data needs to be, very clean. But I agree, if everybody could afford this data, probably the predictive capabilities would be much more overt.
Yeah. First of all, types of data. that's my personal view of the world. I think that two categories. One is observing the mood and the situation and the anticipation. The other one is what is happening. Very simple stuff. I like the IFO index. It's a German index, and it has two dimensions. It has the expectations on one side and the current situation. And this matrix is very interesting because the markets move through these quadrants over time. So I think you need one data source which captures the activity level, and the other one that captures the mood of financial markets. And you have to contrast these two because you want to beat the financial markets. That's your job. Now, the budget is certainly one thing. What I notice is from talking to these alternative data providers that you can always be the second, third, or fourth, or fifth user of this type of data or a certain defined type of data, and then you get it much cheaper. So for testing, building models, this should be a data source that even small players could afford, at least to build the models. And once you have a model that seems to work, then you should be able to move forward and go to the head of the line and pay more to have it more in real time, these data. And it should be worth it because we are playing with big amounts of money here. And to get this little competitive edge should be worth the data costs that we incur here. So it is an obstacle. I think some data are also overused. But if you are creative and know what you're looking for and you can ask for it, then I think the cost question shouldn't be the major question here. I mentioned the IFO index, which is available free. Lots of satellite data seem to be free, in my opinion, not real time, but with a delay. I believe that you can find data about internet usage live online every day, about cyber attacks online, real time. I think there are many sources, and you don't have to buy everything. You have to buy the stuff that is specific to your problem, and I think you should be able to afford it.
You mentioned the AI funds, which have a longer-term holding period or holding forever. Let's say, just say for 6 months. Leading into the novel event, I can imagine some of these funds, like traditional funds, were holding airline stocks and tourism and all the things that are not doing extremely well. So if you're not going to rebalance, let's just say 45 or 60 days, then you're pretty much stuck with those non-crisis resilient holdings, correct? And so I think I would say that funds who have an ability to hold in shorter periods, once again using various asset classes and investment instruments, have much better ability to adapt to the after effects of a novel event. They just have the tools. So that's sort of my thought on that.
Well, it was easy to study all this. We had a volcano, the Icelandic volcano that blocked the world traffic for a while. We had the first Corona crisis. We had a couple of flu events. So it was relatively easy to ask if your models are resilient to external shocks, if you want to do it. And in all these cases, what we're currently observing is that mobility and interaction between people is hampered by the lockdown. But we had similar situations earlier, and I think if you do a test through these types of crises, you should have been able to see the resilience of your stocks. But that means you have defined the question beforehand and said, how do I find resilience, and test it through these situations. If you just put in stuff, any stuff, then you don't know what to watch out, to look out for.
With regards to your the data and the charts for the AI universe, My observation would be, and it's no excuse for these funds, is that many of these funds have a very short track record, which is not an excuse. And of course, it's all about innovation. So I would say a lot of the funds, and I didn't look at all the charts, but a lot of the funds have got, let's say, under 1 year of a live track record. Of course, there are many years before that where they've done, all the back testing and research and development. But as we know, once you get into live trading, sometimes the validation of that R&D is not necessarily there. And it's all about sort of aligning expectations with investors. So it's new stuff, short track records, and as long as you're communicating to investors about that, I think that they will, understand and sort of stick with you. You had mentioned the Tungsten Fund doing well, outperforming its non-AI peers in the managed futures sector. Yes, that has a long track record, as you said, back to 2013. There's another fund that's going to be presented here today, Get Capital, which has also done well in this environment, and their track record goes back to 2012. So maybe there's sort of, an association between a long track record in this area and the short track records. And, let's see at sort of the next event, if, in, a couple of more months or 6 months, that these shorter funds and track records and that they perform a little better. Plus, this novel event will have ongoing effects, a second level of fear, and so forth. So let's just see if these models have learned from, from the first wave.
Yeah, I think this is a very young industry, and the reason why I'm saying this is we have to draw conclusions, what to do better the next time. And this was a perfect test to see if the models are fit reality. Some of them have not done well, so we should draw conclusions out of this, including myself, including my own company. And that is the reason why we are here, to see which way we should be heading and what is the best way to go forward. Now my time is up.
Hendrik, thank you very much. Enjoy your weekend, a lot of food for thought, and we'll see you next time.
Okay, thank you.